The stock market is ripping at the time of recording this video as Jerome Powell is wrapping up his speech. And I will tell you why. It takes about 10-20 seconds to explain this. Powell is not super concerned about inflation. Powell is your friend. That's what we're getting out of this. The administration may not be, they may not care about the stock market, they may not care about the damage to the economy in the short term, but Jerome Powell is boosting confidence in markets. That just because if we see a little bit of inflation from tariffs, Jerome Powell will not hesitate to accommodate the markets. That's what we got out of today. So it looks like, in simpler terms, the Powell put is still here. And that's what the markets love so much about today. Now, here in this video, I will share with you the pre-written statement by the Fed, the dot plot, and how the dot plot is really Goldilocks, if I were to sum it up, and some of the biggest statements from Powell that has markets, as you can see, pretty damn excited. You also have the bond market that is reacting very well. Bonds are going up following a reduction in quantitative tightening, dropping the capped threshold from 25 billion down to 5 billion. And I'll explain what that means in this video. But first, we should start with the biggest statements coming out now from Powell. Jerome Powell says forecasters have raised their possibility of a recession somewhat, but it's not high. Powell basically said here during this part of the conference today that you're seeing sentiment essentially fall off a cliff, but it's not reflected in the data yet. And Powell does not know if that will get passed on into hard data, if that's kind of a leading indication, or if people are, still spending the same. And Powell specifically used a reference like this. He said that people are going out, they're filling out surveys saying they feel really negative, but they're going out and buying a car. He doesn't know if that's going to stop, if some of that negative sentiment will feed into the actual economy. Jerome Powell is also kind of playing down the inflation concerns again, which has the markets excited. He says, quote, "I'm not dismissing the rise in short-term inflation expectations, but there's no story of an increase in long-term expectations." But he's also not sounding incompetent either. Powell says tariffs tend to bring growth down and inflation up. But again, he's kind of sounding a little concerned, or attentive maybe is the best word, towards that growth slowdown. That just because inflation may go up short term via tariffs, it's probably not going to be long term. And if that brings growth down, they really have to focus on both sides of their mandate here. Jerome Powell says that he still thinks reserves are abundant. You could see this in the reverse repo markets that we cover quite frequently here on the channel. The numbers have come down, but you're still sitting at decent numbers. Today you had 193 billion. That was a really high day. But like on March 17th, you had 89.5 billion. And Powell just thinks if you can slow this down, you can run off the balance sheet a lot longer. And that's what the Fed is trying to do. And Jerome Powell says some of the flatlining in Fed projections for core inflation this year is from tariffs. Jerome Powell says the drop in sentiment is partly due to with big changes by the administration on policy. Jerome Powell says, broadly speaking, forecasts point to weaker growth and higher inflation, which call for different responses and cancel each other out. So he's saying a little bit higher inflation, little bit worse economic growth, not something we should react to until we have clarity on what kind of wins out. Jerome Powell also gave us a little bit more guidance on inflation. He says we're looking for direct evidence that particular pieces of inflation are caused or not caused by tariffs. Powell goes on to reference housing services inflation. Like if that were to rise, that would be a sign that maybe tariffs are broadly raising inflation, not just tariff products or tariff services are the source of inflation. So that's kind of saying, well, if tariffs cause inflation, they cause inflation, and it should be short-lived. But as long as we don't see inflation broadly from everything via tariffs, we'll be okay. And Jerome Powell is basically kicking the can down the road again with this statement. He says, we will know in a couple of months if higher goods inflation in the first 2 months of the year was from tariffs. And Jerome Powell really dismissed the University of Michigan inflation expectation reading, calling it an outlier. So that's something Wall Street's been really nervous about recently. The highest 5-year inflation expectation since 1993, the highest 1-year inflation expectations since around that same time. And Powell says, yeah, they're looking at it, but they don't hold it with that much weight. And Jerome Powell says, if an inflationary impulse will go away on its own, it's not the right thing to tighten policy. This is part of why markets are reacting so well to this. Because again, if we see a short-term blip from inflation, Powell's not going to kill the economy to rectify that. If you could even rectify that, because it's from tariffs, right? So Powell is really showing a lot of competence here, saying we're not going to sacrifice the economy if inflation is going to be short-lived. And we're not going to assume that inflation is going to be a long-lasting thing from tariffs. That's different than what you had December 18th, where Powell sounded more concerned about the impetus of tariffs and inflation. And that's why the S&P fell 3%, following Powell's speech from last month. I also think part of this as well has to do with the markets already being in a pretty rough place. I don't think Powell wanted to add more fuel to that fire, if you will. And that's also probably why he's sounding a little bit more competent today, not trying to steer the markets, towards further pain, because Powell knows that if asset prices fall, you're likely to get even further weakening in the economy. And Jerome Powell says that higher goods inflation is likely tariff related. Jerome Powell said, really, for the better part of 2 years, we've had a lot of progress on goods inflation. At some points, goods inflation was actually negative, and service inflation was the area that was the problem. And now, the last 2 months, you've seen higher goods prices, some of which have to do with just businesses getting ahead of tariffs and raising prices before they go into effect. And that should be something that is relatively short-lived as well. Goods tend to be like almost deflationary over time. As imagine a TV, right? It used to be $3,000 for a 50-inch TV, right? Flat screen, like 15 years ago. Now you can get it for like $200. Okay, they tend to be deflationary over time. So if tariffs only really affect goods, then that should not be something the Fed really reacts to. And that's kind of the narrative that Powell is pushing today. Jerome Powell says we've had a low firing, low hiring situation, and goes on to say that if we were to see layoffs rise faster than expected, and the hiring situation stay the same, the Fed would be in a position to react to that. And that's where he says that here, hiring rate and layoffs are both low. A meaningful increase in layoffs would probably translate quickly into unemployment. Jerome Powell says the costs of waiting, given the solid economy, are still low. So meaning, even if we do have a retraction in growth, there is time to wait here to be certain that they are making the right call. Jerome Powell also says that survey data shows a significant rise in uncertainty and downside risks to the economy, which again, markets are liking the fact that Powell's not hanging on to the higher inflation expectations like surveys and, the 2 higher inflation reports that we've seen. He's also acknowledging that there could be downside risk to the economy, and they're not just going to sacrifice the economy for short-term inflation, because again, Powell goes on to say that if you react to short-term inflation, let's say raise rates or hold rates too high for too long and the economy weakens, by the time you understand that inflation is going away or it was really transitory in nature, then you're already sacrificing the labor market. And that's not something they're willing to do. And we're back to literally transitory. Jerome Powell says the base case is that inflation will be transitory. He says that this dynamic is different today than it was during COVID. And I think that really has to do with the push and pull you're getting, like less government spending that's deflationary or disinflationary in nature. And then you have tariffs that tend to be inflationary in nature, right? It's not just money printing that is fueling the demand. We're not giving out stimulus checks. And if that, were to come to be a thing, obviously I think Powell would feel a little bit different on this. But I think he's a little bit more confident saying that this inflation round should be transitory. And he literally said transitory on the podium. Jerome Powell says, my base case is that there is no policy signal from tariffs, but I can't know that. So really, in summary here, again, markets are down a lot. We kind of want to bounce. I think that the bounce wants to continue to flow through. Now, it does look like we hit that 200-day moving average, getting a little bit of rejection there. But again, it really just comes down to the administration's not your friend right now. They don't care about the stock market. They don't care about the economy in the short term. But Powell is clearly caring, okay? He doesn't want to make a bad policy judgment right now. And he's not overreacting to the 2 months of quote-unquote bad inflation reports that we've gotten. He thinks that tariff, inflation mixed with a weakening in economic growth is not something the Fed should react to. And I think the markets like that. And I think the markets really like the support that Powell gave, that if things get bad in the economy, even if inflation is rising, Powell will cut rates into that. Powell will not, let the economy just free fall into recession, even if we do get short-term inflation, higher readings from tariffs. That's the bottom line that I'm really going to take away from this. Now, also in the bond market, okay, bonds are doing well today because of that balance sheet reduction, right? From 25 billion down to 5 billion. So essentially, if you have $40 billion of treasuries that mature, let's say in April, okay, the Fed's going to let roll off 5 billion. So they're going to go out and net purchase 35 billion. So 40 billion expired. They purchased 35 billion. So you're actually reducing the balance sheet only by 5 billion instead of previously, if they were to let 25 billion roll off and 40 billion matured in a single month, that would mean the Fed would only go out and purchase 15 billion worth. Okay. So the net of that is more buying, more support to treasury markets, which is why TLT is going higher. And I think that's kind of a nod to the administration. I think that's kind of what maybe the administration is kind of pressuring Powell to do. But nonetheless, I think it makes sense to do that after the Fed has reduced their balance sheet $2 trillion. So that's the best way that I would kind of summarize today. Does it mean everything's fine? Correction over, bull market's back? Not necessarily. We need more data. We need to really figure out, is the economy slipping into a recession, right? What's the problem here? Is inflation the problem? Is the economy weakening the problem? We still don't have clarity from that standpoint, but Powell says, I'm here. I got your back. We're not going to let the economy just fail in front of us because of what is likely temporary inflation to begin with. Now, with that said, let's go over the dot plot and the summary of economic projections, because again, it was kind of Goldilocks here as well. So first and foremost, you're going to want to look at this left side of the column here, the median, okay? The Fed, they lowered their GDP projection for this year from 2.1% down to 1.7%. They raised their unemployment projection from 4.3% to 4.4%. They raised their PCE inflation target from 2.5% to 2.7%. They raised their core PCE inflation target from 2.5% to 2.8% by the end of this year. But they kept their federal funds rate projection the same at 3.9% by the end of this year. 3.4% by the end of next year, 3.1% by 2027, and the longer run 3% neutral rate remains the same. So for any year, nothing changed on the path of the federal funds rate. So we essentially got no change. That's good in this environment, right? Where there's a lot of uncertainty about growth, where there's a lot of uncertainty about inflation. The Fed's saying, nope, we still see ourselves doing the same thing as we seen in December. Like nothing has changed from that regard. So in summary, the Fed lowered their GDP expectations. But I mean, they went from 2.1% to 2.7 to 1.7%. You're still out of recession by a long shot by the Fed's, projections here. They think unemployment's gonna tick up further from here. We're currently at 4.1%. They expect that to go to 4.4%. And they expect inflation to be a bit of a problem this year, but not enough to raise rates or not cut rates. So the Fed is still projecting 2 rate cuts by the end of this year. So again, it was Goldilocks because the Fed acknowledges weaker GDP. I mean, let's be honest, the Atlanta Fed GDP Now tracker is tracking negative 1.8% GDP. The Fed had to lower their GDP projections, but not in recession. So that's good. Inflation to move higher this year, but not spiral into another large wave of inflation, and still making enough progress to cut rates twice. It was about as good of an SEP as you could have possibly imagined. I'm surprised the Fed did not lower growth estimates even more, but I think the Fed also doesn't want to spook the markets already being down 10%. But I think if you ask most people on the Fed, even at 1.7%, that's still a pretty high estimate. Tesla stock is up 5.5% today. And this is so important to Tesla because automakers, heavy beta companies, high growth names with higher valuations are really vulnerable during recessions, right? Those are the stocks that get absolutely decimated during recessions. And if Powell basically said today, we're going to do all we can to avoid a recession, if we have to react to the economy weakening, we will do that. Okay, Powell is the market's friend now. Okay, that bodes really well for Tesla specifically, being a high beta company, high valuation company, high growth company. That is exactly what you wanted to hear out of Powell. And that is why Tesla is doing so well today, mixed with this other news. And the big news today for Tesla is that the stock was upgraded to overweight from neutral at Cantor Fitzgerald with a $425 price target, citing takeaways from their Giga Austin visit. They said, quote, upgrading Tesla to overweight. Takeaways from the visit to Austin's Gigafactory and AI data centers. On March 18th, we visited Tesla's Cortex AI data centers in the factory's production lines ahead of the company's introduction of its robotaxi segment targeted for June in Austin, followed by California later in 2025. With Tesla shares now down 45% year to date, we upgrade Tesla to overweight from neutral ahead of upcoming material catalyst. Our $425 12-month price target is unchanged. Our thoughts? Attractive entry point ahead of material catalyst. We believe the recent sell-off represents an attractive entry point for investors with a 12-month plus investment horizon and who are comfortable with volatility. We become bullish on Tesla ahead of material catalyst, including the introduction of robotaxi segment June 2025, rollout of FSD in China starting in the Q1 2025. That has already happened. Rollout of FSD in Europe, we expect first half 2025, pending regulatory approval. Introduction of lower priced vehicle in the first half of 2025, we expect initial price of $30,000, inclusive of tax credit. High volume production of Optimus Bot 2026. Initial deliveries of Optimus to customers, we expect by fourth quarter. End of year this year or the first half of 2026, and introduction of semi-truck. We expect SOP in the second half of 2025/2026. For 2025, Tesla recently disclosed that it expects its automotive business to return to growth, produced and delivered 1.8 million vehicles in full year 2024, and for its energy storage and deployment segment to grow 50% plus, and that grew 113% in 2024. However, we expect Tesla's automotive business growth to be partially offset by tariffs and the likely removal of the EV tax credit, both of which we expect will have a material impact to the industry. We also expect a mild Q1 driven by lower demand in Europe and increased competition in China, plus some negative sentiment from Elon's polarizing politics. Recall revenues Recall revenues from China and other regions accounted for 21% and 30% of total revenues, respectively, in full year 2024. Overall, we are bullish after our factory visit, and after the recent market sell-off and share underperformance, we see future revenue upside from FSD, robotaxi, energy storage and deployment, and Optimus bots to be fundamental to Tesla's thesis over the long term. And what's also going pretty viral today is Tim Walls. I don't know if this was some kind of like comedy show or something, but
saying on my phone, I don't know, somebody noticed on the iPhone, they've got that little stock app. I added Tesla to it to give me a little boost during the day. 225 and dropping. So.
What a loser, man. Rooting for the most American auto company, or most people would categorize Tesla at this point as an auto company, but most American auto company in America employs 80,000 Americans, essentially rooting for that to go bankrupt. It's just so much hate. It's crazy. We live in a moment where politicians are essentially praised for being so hateful. That's just loser mentality to me. I don't know. Maybe I'm wrong. Now, if we also take a look at Tesla's option activity today, it is on the low side. You have 128 different trades totaling $76.5 million with a positive order value of 32%. If we take a look at what the short sellers are doing today, they're actually shorting a fair bit of Tesla. Currently, it looks like on net, shorting about 1.1 million shares of Tesla. That's a pretty rough number relative to what we've seen recently, where short sellers have really been covering on those short positions. So let me know what you guys think about this down below in the comment section. Ladies and gentlemen, have a fantastic rest of your day. And we will talk about, what this means going ahead for Tesla, what could be coming next for Tesla in the next video. So stay tuned to the channel for that one. Have a great rest of your day, and I will see you in the next one.